Let's bring in Jason Thomas, Head of Global Research at Carlyle. Jason, great to have you with us. Thanks so much for joining us. And I guess your argument, or part of the argument in this report, is that we've seen a lot of dispersion between different industries in the recovery post the COVID lows. You think that will actually broaden out to be dispersion within industries?
That's right. I think when investors look at the investment environment today, they're really very focused on the difference between industries, those that are impacted by the pandemic, of course, travel and tourism, physical retail, hospitality, and then those industries that have done quite well, tech, healthcare, now single-family house construction. What we perceive is that over the next 2 to 3 years, the wider and more salient dispersion is not going to be between industries, but between businesses operating in the same industry. And that's because there's going to be those businesses who effectively want to manage backwards to conditions that prevailed in January 2020. And then there are going to be those management teams that want to build better businesses and effectively take the pandemic and the shock as an opportunity to rethink everything they do and how they do it.
Is there still time for a would-be loser in that environment, if you were to snapshot things today, to rectify the situation, Jason, or would you have had to have been putting in the investment, laying the groundwork for the tech era in recent years past in order to be prepared for the next couple of years?
No, I think that this is an opportunity for everyone today. I think it's just a question of whether those management teams are willing to seize it. You know, what's interesting is when we look at the investment environment, whether it's public markets or private markets, 85% of the value, enterprise value of the corporate sector is intangible assets, brand, data, content, the human capital, et cetera, proprietary technology. And what's interesting is that everyone focuses on big tech, but it's really the tech-enabled platforms operating throughout the economy. But it's also actually very many traditional businesses. When they look at their enterprise value, what's really valuable about the business? They find it's their brand. They find it's their customer relationships. They find it's the data about customers, data about suppliers. So it's really just a question of these businesses and their ability to refocus attention on where the value lies and where the growth opportunities are.
So what is the takeaway here, Jason, for public investors, besides just buy all these software companies that are speeding up the digital adoption?
Well, I think what's interesting is that for many public investors, they're very focused on tech. And really what we've shown in the report, the Carlyle report, that I think is perhaps most interesting, is that when you control for business model, actually all the tech sector outperformance goes away. And again, what that means is that the biggest and the most consequential innovation of the last 12 years is not an app, it's not a device, it's these digital platforms, these business models that now compete in areas like durable goods manufacturing, personal care products. And so I think that the opportunity for public market investors is to actually identify those businesses that are perhaps not labeled as tech, not perceived as tech, but actually have these very valuable intangible assets that can actually allow them to have a tech-like growth profile. And that's something I think that you can also observe in private markets, again, trying to capitalize on those growth options and opportunities.
Jason, clearly the U.S. has led in terms of tech innovation over the last decade, perhaps the last 2 or 3 decades. What about the next decade?
I do expect the U.S. to continue to lead, but of course China is closing the gap. When we look at, so for example, these digital platforms that I'm mentioning, that's really where all of the startup capital is going. It's where all of the growth capital is being directed as well. And when we look at the 2 most vibrant markets for growth capital, it's of course the United States and China. And over the last decade, China has closed the gap with the United States in terms of Fortune 500 companies. As of 2019, there was 129 in China, 121 in the United States, the first time ever another country has been home to more Fortune 500 businesses. Over the next 10 years, I think China's also going to close the gap in terms of these fast-growing digital platforms. I think the U.S. will still come out ahead, but it's going to be much narrower than in the past.